I was going to do voiceover, but I guess I lied. Did I lie?
You were spontaneously changing the direction of the conversation.
Yeah. So anyway, this is an exciting topic. We're going to talk about energy markets, which are in an incredibly volatile place, and especially over the past few days. And you can see this real quickly. And when we look at natural gas coming all the way down to $3, and then crude oil coming down to the 61, 64 level, which we'll talk about that level a little bit later. But what we're going to talk about today is energy markets in crisis. There's no return to normal. Global energy markets are facing unprecedented disruption. Oil and gas is caught in a perfect storm. These are permanent structural changes by the end of the year. So Bill is smiling because he's probably going to make fun of my title. I don't know. I thought that was a good title. Maybe not.
That's with all the negativity, man.
Is that it?
You know,
Is that
I'm just trying to think about all the times that we've had unprecedented disruption. So if we've had it more than once, how could it be unprecedented?
well? But here's the thing. Here's the thing to contemplate and think about is 1% of the market on supply or demand changes the dynamics significantly. And that is applicable on natural gas, that is applicable on crude oil. 1% moves the market. So if we have 1%, and the problem is that we have variables that are much bigger than 1%. So when we look at these variables, we'll get to natural gas a little bit later, but we're going to talk about crude oil and natural gas. They both are at the center of volatility right now.
I'm not sure
And
I'd call it unprecedented. I would call it significant. How's that?
This is the part where Shaggy and Scooby continually refuse to do something until we bribe them with treats.
There you go. You have described tariffs in one little clip.
all right, so listen, we're gonna keep this to about 30 minutes. So if you're with us, great. Drop us a comment. We will try and hit those questions live. So oil market. We have a 30% demand uncertainty, and what we established or discussed earlier, 1% moves the market. And currently, we have a 30% global consumption questions that are persisting. We've been relying.
So let's do a timeout here. You're throwing percentages around pretty strong here. So it's 1% of the fundamental production. The production goes up 1%, it goes down 1%. It significantly affects the price. It may or may the price affects demand.
Right.
And so when you talk, you see what I'm saying? I don't want to confuse the percentages here.
Yeah.
And so when we talk about demand uncertainty, the uncertainty is whether or not this is a percentage of the probability of what's going to happen with the demand as far as the need for gasoline and diesel. That's what in the oil market, that's what you're talking about is gasoline and diesel.
Yep.
And so when we say there's a 30% deal, it's how much of the gasoline and diesel are being either replaced by electrical vehicles or the economy is down that we're not moving goods. Therefore, the demand for the diesel is down because diesel is the big factor as far as moving commodity. I mean, not oil commodity, but all the other commodities. And so the 30% demand uncertainty falls on both the economy and on the replacement of fossil fuel as a motor transport. Now, a lot of people say, well, okay, in America, we're not doing a lot of it, but in China, they've gone electric big time. And the biggest thing that we're seeing in China is where they're rolling over their big haul trucks to electric. Now, I take everything I hear coming out of China with about 50 grains of salt. So, but when we talk about percentages, that's what we're talking about on demand uncertainty.
These cars are supposedly insanely efficient, and this is not coming from China. This is coming from other countries that you can purchase a car like this. This is like a Tesla, but this is China's version, and apparently you can
Right.
charge it very quickly, like within 20 minutes. And I think Teslas take a lot longer to charge. I'm not an electric car expert. If you know, drop it in the comments. Let me know.
Yeah.
Um,
All this is about the expense of the vehicle and how many people are going to be able to do that. And
right.
if you're in your 15-minute city or your 30-minute city, electric cars make sense. If you're in the flyover states, electric cars run out of fuel too soon. So
Right. Right. So the oil markets
that
in oh,
that's
go
the
ahead.
30%. Yeah,
Yeah.
that's the 30%.
What this results in is over $15 billion of a tariff impact. I think that is actually remarkably understated, but this is kind of a high graded number that was taken out of the news, and it does result in about a 60% volatility potential impact to the price. So we have the possibility to decrease the price by 30% or increase by 60%. So the demand fundamentals are shifting, and this is what Bill was talking about. Traditional demand erosion in some of the advanced economies, or I should say, mature economies, with industrial consumption patterns are stable. They're not really declining, but they're not really dropping. They're kind of stable where they're at. Where we see crude oil, where we see crude oil consumption rise is in growing markets. And there is a shift happening on the transport electrification and the EV adoption. This is also at the same time that fuel efficiency has continued to increase. Sprinkle in recession fears? Should we sprinkle in recession fears?
You
But
know, how long have we been saying that we've been in a recession that nobody's been paying attention to us? And I'm starting to hear people now say we're probably already in a recession. It goes back to
talking
all the
about it
definitions,
in 23,
right?
didn't we start talking about it in 2023?
We did. Yes, we did.
Yeah, yeah.
Yeah.
So I think you were the first to bring that up. So tariff fallout intensifies. Supply chain is in a little bit of chaos as the pieces are being rearranged around the globe. This is um, very similar to COVID, except for a lot slower moving because it's not a shock. It is a slower moving change, but it is still way faster than any other change in trade policy, any other change in tariff policy that we have seen in the past. This has come so fast, so quick that most of the markets have not been have not absorbed what this actually means for the long term. So it changes delivery disruptions, logistic costs are soaring. So we have a implication of a lot of different imports and exports on what that means from a trade relationship. And that is going to have a ripple effect throughout the economy. This is likely going to increase inflation, consumer costs, and market accessibility. For instance, you may not be able to get that new widget because of new tariffs that are imposed against China, but day by day, check the news every day because are they on? Are they off? It kind of depends on the day, you know. So,
Just remember
speaking
this.
of,
He's
are we
using
on?
this for
Are they on?
negotiations.
Are they on?
They're always on. We've had tariffs forever. They've
No.
always
But
on. We're just
I
playing with the
mean,
numbers.
no. What is the state today? What like? Does anybody
Well,
know?
we entered into a 90-day pause. So
Yeah.
for everybody but China, I think, maybe Russia too.
Yeah. Of course,
So,
I saw
so are they
tidbit
on?
that we might pause that too. So
Well,
strategic
it's
shift.
going to. It's the good news is going to change. The bad news is going to change. So
Now, this is also driving a lot of strategic shifts, such as new trade alliances that are forming.
Right.
Regional self-sufficiency is being prioritized. So this is something that that if I had my 2 cents, I say that this protectionist stance is about 5 years too early on a positioning because the chess pieces aren't in place for the Western nations. So that is actually my sentiment that this is misguided for right now. So, but Bill and I go back and forth on this because he thinks it's a good trade stance. Well, I think he does.
Not, it's not a,
What does Bill think?
Bill thinks that we have to shake up things in order to get to where we need to go. And we've been kicking the can down the road for 50 years. All of a sudden, you know what happens when you kick the can down the road, right, Brian? You run on the road and a whole stack of cans. And so I think that this is a negotiating tact. I think when it's all said and done, we've probably shook up some countries that should have been doing more about their own situation a lot sooner. Now all of a sudden they're having to. And I could list 3 or 4 of those right now that have finally said, "Oh my gosh, we might actually have to do something for ourselves instead of waiting for the U.S. to do it for us." And so I think we're
are you doing in my swamp?
exactly. And I think what it has done, it has forced some countries to do what they need to do. I think when it's all said and done, we're not going to be far off from where we started. And I think that's the part that people don't get it, that this is not a permanent change. It's not like our tax policy that never goes away. This can be
Yeah,
changed in the next president
yeah,
or the next version of Trump within himself in a year from now.
yeah.
So,
Um,
but it's bringing a lot of discussions to the table and saying, "Hey, you know, this is real life, and
and
we can't afford to take on any more countries as our we can't take care of all those countries. When you're $37 trillion in debt, you really can't take on too many more people. Now, I'm not
yeah,
talking about immigrants. I'm just talking about any additional. So we got to balance some things out. It's going to, and this is not a problem that's going to solve in one administration. This is something's got to be problem probably the next 50 years. My
right.
grandkids will be wondering about this one.
Well, this is part of this is part of the reason that I think that the chess pieces aren't in place. It's kind of like
So,
having a gasoline car at a remote gasoline station, and you yell at the owner that you're not going to buy his gasoline when you're almost on empty. You don't really have any other options. So I
well,
equate it
but
to
the
that.
problem is that but you're also just yelling. You're not building another gas station.
Uh,
I mean, if you
well,
really
yeah, yeah, yeah. Well,
okay,
that's what should happen. Well, that's why I'm saying you don't yell at the gas station owner right now. You build the station, and then you can yell at the gas station
well,
owner.
our problem is that we're not yelling and we're not building the station. So, uh,
Well,
so
and so Bill and I go back and forth on these issues every single day, and we do not share the same opinion on the outlook of this stance on the tariff policies. But that's what we're about. We're about the debate. We're about finding the
right.
answer in there. So we welcome you
So
to the
think about all the
conversation.
questions we've raised in the last 90 days.
Mm,
Unbelievable, isn't it?
yeah,
90 days, Brian.
yeah.
90 days.
Mhm.
Me and you've talked about in 90 days, we've seen gas change, double in price or half in price.
Mhm.
And had nothing, and that was in the last administration. So when we start talking about this, is that we need to understand that natural gas is no longer a U.S. deal. It's a global market, and that's with LNG, it's a global market. Now,
Yep.
are producers going to are they going to drill wells in this price infrastructure? No, they're not going to. They know what it takes, and so that's going to cause some disruption for sure. Um, so we talked about drill baby drill. That's not real unless unless the companies can make money at it. Now, there's a lot of people arguing about how much money they make and how much they're doing it, but it's not like they're going to give it up.
Right. Right.
And by the way, as you complain about how much money the oil companies are, just remember that your 401k is probably funded somewhere by an oil company. So uh, it
Explain that one.
it
I
is
don't know
integrated.
what you're saying there.
Well, so whenever you got 401k, especially if you've got a some sort of pension, all these major funds buy oil and gas stock because it makes them money. Therefore, it makes you money.
So you're saying the mutual funds have an oil exposure from an investment standpoint.
Well, every mutual fund, every kind of every other type. Because, well, let me ask you this: even if your particular fund you don't have any oil and gas in it, but you're with a fund manager that has a bunch of other ones that have oil and gas, you're affected
Right.
because that fund manager still needs to make money.
Yeah.
So
Yeah. Yeah.
it's an interesting that yeah. I don't think people realize how integrated oil is into our total economy, and so because of that, it's going to be things that we're not looking at that's going to affect the market. And that's what Brian and I always try to do is look for those things that make a difference in the oil and gas price that no one else is thinking about.
Right.
And that's what we
Yep.
bring to the table. You
Right.
know, there's a lot of different things. And
Yeah.
I thought that in our Discord channel, I thought the discussion on propane today was a very, very viable discussion. When we start
Hmm.
talking about how propane, uh, the market for propane could have a significant impact on gas, putting more gas into the market. I mean, there's a lot of things that go in it. So it's not as easy as 1 + 1 = 2. Right now we have 1 + 1 = 27. So there's a lot to it, and we would love to sit down and talk to you about it. That's why we have Energy Road, is because I'm not going to say we have all the right answers, but I feel like that most of the time we have all the right questions.
Well, and
And
if
so
if you're listening and if you follow the energy markets, whether it be natural gas, crude oil, refined products, natural gas liquids, we offer two products, Rogue Radar, which is right here, where we take a look at various things that are happening in the marketplace. We cover, let's see, technical analysis, fundamental analysis, weather, economic, the commitment of traders, LNG, news and sentiment, Fibonacci levels, learning price prediction, and AI analysis, alongside with videos where we cover what is happening in the marketplace. And we provide two PDF reports throughout the week, Monday Game Plan and Rogue Radar, which gives you a convenient red light system. And then for people that need that extra layer of insight, we have Rogue Edge, and Rogue Edge is packed with anything and everything that you want to know. I just had a call this morning with somebody on the electric market, and they didn't realize that we're tracking an hour by hour basis what is happening on our electric grid in the United States. So this is a dynamic, and you can actually take a look at various factors here. For instance, one of the things that we were discussing is the possibility of blackouts and brownouts, because the distance from here to here is stretching power grids. And that is actually something that I was able to talk that through. So we cover electricity markets, refined products, crude oil, natural gas liquids, natural gas. If you are serious about the energy markets, we offer two products, energyrogue.com. There's links below. You can find out what we serve And at the end of the day, if you want to book a meeting with us, we'll give you a tour. We have Rogue Radar at $89 a month and Rogue Edge for $179 a month. And Rogue Edge gives you access to our Discord channel where we talk about these issues every single day. So, did I miss anything in the commercial?
I don't think so. I think you got it right there. If you did miss anything, guys, just reach out to us. We'll
Yep.
be more than happy to sell your stuff.
Yep. So, natural gas market crisis, and the main thing is that we wanted to focus on education. We do offer a product. Would love to see you inside, but if you, let's just say, if you're serious about energy markets, you need to invest in your insights, or you're going to spend 30 to 40 hours a week trying to keep up. So, investing in the insights, there are many choices out there. We feel like we're the best, but we have a biased opinion there. So we feel like it is the best
Oh,
price
you call it
point.
biased. I call it an expert opinion.
Yes, that is true. That is true. So anyway, natural gas market. I was asked about this from one of our members the other week. They said, well, what do you think about natural gas on price? And I said, well, I can at $3 paint a case of $5 and $1. I can paint that case. And he said, what do you mean? And I said, well, if we take a look at it, let's actually go here. Yes. All right. So right now we have included in the other demand right here. Let's see, what is this? Let me get my pen out. Bill loves when I draw. On LNG, and I write with my mouse so it looks funky. We are at 16 BCF a day. Let's actually take a real number that is on Rogue Radar right here. And let's take a look at this. Okay, LNG exports are 16.8 BCF a day out of 106 BCF on production. So in 2022, we saw Freeport LNG go down and thrust 2 BCF back into the U.S. grid. We went down by $3. Now we were artificially inflated a little bit higher at that time, but right now on our LNG exports, who do we export to? Currently in January, which is the latest numbers published, February should be coming out in the next day or so, we were sending roughly 60% to Europe and 25% to Asia. If you took that back about 6 months, it was about 35% to Europe, 35% to Asia, and the rest was a smattering of South American and other countries and other regions.
Right.
Now we have aligned a little closer with Europe, but with tariff discussions coming back into play, what happens if those LNG cargoes get shipped back to the US? Then maybe it goes to Asia, but right now we're in a tenuous spot with China. This opens up to where what Bill was saying earlier, natural gas is now a global commodity. So I just painted a very bearish case that if 2 BCF came back into the grid, easily I could see $2 down. We go from $3 to $1 easily. If
Yeah.
everything else stays the same, that could happen. And then you add
But the
in,
counter of that, and this is what you got to think of. If 2 BCF comes to US, the market didn't go away. So that 2 BCF has to be replaced by somebody else in the world.
that's correct.
And who's capable of doing that,
Qatar.
And so typically what Qatar could do it, Australia maybe could get part way there. I think Australia had some other problems internal that they struggle with. Qatar could do it, but I don't. Let's say Qatar has the gas. I just don't know if they have the ability to push out 2 BCF more of LNG
Or Russia.
without building some facilities.
Or Russia.
And Russia's already putting it out.
Yeah. Well, they're
The
throttled
thing
back.
is that
The deliveries from Russia are down from pre-war conditions. I could see those toggling back up and a
right,
little bit of a scale back on US LNG.
yeah, yeah, I don't know. I don't know if Russia's got the money to do that after funding the war. Um,
Maybe
I
not.
think the biggest thing is that would it go somewhere else and then be redirected? And that's what's been happening in world trade. That's exactly what happened to us when we put tariffs on China. All they did is shipped it to Mexico, then we brought it up through NAFTA. And so those are the kind of things that's going on in the world. And so that's where you have to look at that. So that's where I would paint that. I don't think 2 BCF would come back, but I could easily see half a BCF come back,
Yep.
which would still have the same effect,
Yeah,
just not all the way
it may
down to
not
one.
impact us $2 down, but now
Right.
let me paint another bearish case. Another bearish case is that power demand, and this is the power of Rogue Edge. Let's take a look at this. I was just showing it to somebody this morning, and when we look at electric power right here, and we look over the last several years, I'm going to take it back to 2021 and beyond because we have had what what came out in 2021, 2022, large language models and AI, and you can see the US increase for power driven by natural gas has continued to get higher and higher. The word is that solar and batteries are going to eke into the natural gas demand stack for the summer period. Add in a little uncertainty on the last couple recessions that we had. There was a lot of natural gas to coal switching. So if power demand doesn't grow, that is another very big bearish concern, and that could thrust another BCF or 2 BCF back into the grid. I see that as doubtful, but it's possible.
I think there's another thing coming, especially with AI, and that's beyond the public grid. It is the private microgrids. Well, they'll
Mm,
be taking the natural gas away from the public grids, and the public grids are now more dependent on renewables, which are intermittent. And so I think it's going to get really interesting because let's say that for AI you take 1 BCF of natural gas away from the power companies. Because right now, at the price of natural gas, you're not going to be seeing a lot of new drilling going on.
right.
And so what you have is what you have, basically. And as decline starts to affect it, what you have may not be what you have. And
Well, and that's where
so,
we're gonna get to the other side of the case. Let's get to the other
right,
side. So we painted a bearish stance. So now let's paint the bullish stance. On the supply side, let's actually look at the supply side here. On the supply side, we take in the last week, we took in roughly 6 BCF a day from Canada. Real question is, in January, we actually took up to 9 BCF a day from Canada. So why the difference? Part of it is tariff related, part of it is Kitimat related. So there
right,
is a new LNG facility on the western side of Canada that is going to take roughly 2 BCF a day out of the Canadian balance of natural gas, and that leaves less natural gas coming into the United States. That means that I see without more drilling in Canada, that what we're getting from Canada is going to be what we're getting from Canada. And so I don't see added supply there. Now I add in, okay, well, let's look at the US supply. That's been really growing, right? Not so much. If we take a look at the latest numbers that we have, which is based upon March. That's good. This report updates pretty frequently. I'm glad we got March numbers. If you see, this is a chart that shows if we are growing or shrinking our natural gas supply based on two factors. One is natural gas production declines every single day, every single month. So how much does it decline? This is a chart that tells you by basin what our decline looks like plus new gas. And a little bit further down for those geeks out there that really want to dive into Rogue Edge, we actually split this out on natural gas from new wells. You can see a trend happening right here. We are decreasing over time. Now, this is a chart that this is 2022, and this is today, or that's March. So you can see a trend. We're getting less and less. We did kind of stabilize over the last like 4 to 5, 6 months. And then natural gas decline. This is actually how much we are declining month over month, and we're over 3 BCF a day, which means every single month we decline 3 BCF a day. If we don't add 3 BCF of new production, which we're currently at 2.82, we are in decline. So month over month, week over week, those data points are different, and you're going to have different noise in the data set. But what I'm trying to get back to is our production profile. Let's see, where did I went off that page, that chart right here. So what we do is we take a look at the decline, we add in new production, and what is our net? And what you'll see down here is that we are below the zero line. So that means we are in decline, and it likely means that we're just treading water. So with the number of rigs that we have active, we're likely to tread water, so we're not going to see more supply. So the key parts of the puzzle, if we do grow on power demand and we don't decrease on our LNG and we don't get more from Canada and our production is declining, I could see us go to $4 to $5 very easily. So
Or you left
that's
out one other scenario.
what's
You
that?
left out the Permian hidden effect on natural gas.
Yep.
And that is most of the new natural gas is coming from the Permian because of the oil. If they stop producing the oil out there, they will stop producing the natural gas because it's associated.
In this chart, we can see that the net added production from the Permian. Let's actually look at it basin by basin. So lower 48 is in decline. So it's below the zero line, right?
Right.
Permian is adding. Okay. Haynesville, declining. Eagleford, flat. Bakken, slightly add. I mean, by slightly, 20,000 decatherms a day.
Yeah. And that's mainly because of oil production.
Point 2, is it 0.2 or 0.02 BCF a day? Appalachia is in decline. So that roughly means that the Permian is the only reason that we aren't declining much, much, much faster. So
And take a look at that in the last year, even that's declined.
yeah, that's what I mean, is our net that we're getting from the Permian is in decline. And now add in, well, let's take a look at the forward outlook on Permian rigs. Let me go off this chart. This might be a little easier to work. These are active rigs, and that does not look like a growth scenario. That looks like flat to down. So,
right.
All that said, natural gas markets, I could see plus $2 and down $2. It depends on a lot of those certainties, and this year is different. This is the structural change that we're talking about, to where you're going to have to look at the natural gas tied to the international market, because that's the environment that we're in. The Canadian-US dilemma. We do have a dependency at 6 to 8% of our supply comes from Canada. We have regulatory hurdles, price disparity, and security concerns around that. Now, the export markets on LNG, that's under pressure because of the tariffs. Investment, we have short-term volatility, mid-term repositioning, and long-term transformation. These shifts are happening. they're happening fast. And this is actually something that we posted in our newsletter that came out on Monday, turning back to 61.64, and that's actually what happened today. We also posted on Sunday when we opened around 317 that $3.12 and $3 seems likely. We're not a price service, but we offer our opinion. And part of the reason that we offer that opinion is we want our members to be successful. And our members include producers, consumers, traders, hedge funds, active traders in the natural gas market in the United States, and active traders on LNG cargoes internationally. So we have a broad scope, and this right here gives you the template of everything that you need to know about natural gas in a 5-minute read. And we have so many different factors at play, because let's be honest, you have to track everything on natural gas right now. You have to track all the news on crude oil right now. And if you're not, then that means price volatility is going to come for you, come for your business. And it's better to be equipped so that you can stay ahead of those price trends. So
we're here to help you do that.
That'll do, Donkey.
Actually, Brian, let's be a little bit more
But after a
positive.
while, you learn to ignore the names that people call you, and you just trust who you are.
Well, listen, we'd love to hear from you. We put this out there because we want you to be better equipped. Those are some of the things and some of the aspects that we're looking at in the crude oil market, as well as the natural gas market. And there are rumors of peace in Russia, Ukraine, which is going to weigh down a little bit on crude oil. But bear in mind, as Bill mentioned, that is going to have an impact on natural gas production here in the United States. So that is it. It's important to stay on top of these trends. And if you are trading, if you are producing, if you are consuming natural gas liquids, crude oil, refined products, or electricity, staying on top of these trends is important for you and your business and your bottom line. So stay equipped. You don't have to come to us, but definitely invest either the time or energy or resources so that you can help put yourself and your company in a better spot. So that's, I think, all we have today. Is that all we have?
That's all we have today.
All right. Well, listen, folks, thanks so much. Drop us a like, drop us a comment, let us know how we're doing. And listen, really appreciate you watching and tuning in. And anything that you can do as far as comments and thoughts, we want to hear from you, because we want to keep delivering good value for you so that you are more educated about what's happening in the marketplace. So let us know if we can help. We hope to see you next week, and we'll talk then.
Yes, I told you I was your #1 fan.